This is Tony Hixon, coming to you from the University of Findlay, the center of student life in the College of Business building. There's nobody here. All the students are on spring break. Don't tell them that in the real world, there's no such thing as spring break. Because when you graduate, you get into the labor market, and that's what we'll talk about in this month's Economic Update. In this month's video update, we'd like to talk about what happened in the labor markets. It was February 2nd, 2018, 2/2, Groundhog's Day. February 2nd, my daughter's birthday, and all of a sudden the market dropped. Well, why did it drop? There was a great news report, and the jobs report beat expectations. That blew the numbers out of the water. That's good news, right? Well, the Dow was down. In fact, throughout the month of February, that piece of news drove a lot of volatility through the stock market. In fact, there were days that the Dow was down over 1,000. There was a correction. We were down 11% from peak to trough. But by the time the month was over, the S&P 500 had gained some more value. And by the time the month of February was done, the S&P had lost 3.9%. The Dow was down 4.3%, the NASDAQ down just 1.9%. And so in spite of the correction that occurred, the markets had some recovery. Why does the market react negatively to really good news? Well, really two reasons. The more people that are back to work in the labor market, the more inflation that can happen within the economy. More people can spend money in there. That worried markets. It also worried markets to think, well, my goodness, if the Fed chairperson thinks that the economy is doing so well, he might increase interest rates 4 times instead of 3. And so with those two things going on, the market fell by quite a bit. But volatility wasn't any fun to go through, right? In fact, we had just got done with 15 straight months in a row of positive gains in the stock market. It's never happened in history. That streak was broken in the month of February. So what are we going to do about it? Well, we're focused on the good news. We think that the economy is still very strong. People are going back to work is a good thing. Other economic indicators in housing, in autos, in retail sales, in new home sales, all eclipsed new highs. We're very excited about the economic data that's coming out. So we are bullish for the year ahead. But that's not to say that markets won't correct. If you think back in history, since 1980, the S&P 500 has an average annual decline of around 14%. Think about that. It means on any given year, you can expect to be down about 14%. Well, in 2017, we were only down about 3%. So a lot of investors were lulled to sleep thinking, well, let's just invest, nothing will ever go down. That's not true. On average, the market can decline, and in fact, it's declined around 14% on average since 1980. In spite of that decline, in spite of the 14% average annual decline, the markets have been up 77% of the time on a calendar year basis. So in 29 out of those 38 years, the market has increased in value. So what's on our radar? We're going to be looking at inflation. That's concerning to us too. We're going to be looking at what the Fed chair, Mr. Powell, will be doing on his March 21st meeting. Will he be increasing rates or not? It'll help us understand more about how we'll adjust client portfolios if needed. We'll also be looking at more economic data that will be coming out in the weeks and months ahead. In general, volatility is normal, and just because it didn't exist in 2017 doesn't mean that it's anything to be concerned about here in 2018. Thanks again for watching this month's video update. Again, my name's Tony Hixon with Hixon Zuercher Capital Management. Nothing that we've talked about today should be considered as a recommendation. If you have any questions regarding your portfolio or would like a complimentary second opinion, a review of your current investments, we'd love to chat. Please give us a call at 419-425-2400. We're happy to help. We'll see you next time.
Perfect. There's snowflakes outside.
There are snowflakes outside. Okay. And the labor markets.